Welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. You can also hit the notification bell so that whenever you upload a new video, you are notified. In this video, we'll be talking about regional finance breaking new ground, where Ethiopia opens up its capital markets to Kenya financial institutions. In a landmark move with far-reaching implications for East African finance architecture, Ethiopia has officially opened its newly launched security exchange to Kenya stockbrokers, bank custodians, and market intermediaries. This decision marks more than operationalization of a new market. It signals a strategic shift in Ethiopia's economic philosophy and pivotal moment for regional financial integration. For Kenya, long regarded as East African most mature capital market, this is not merely an invitation, it is an inflection point. It presents an opportunity to export financial expertise, extend Nairobi influence as a regional financial hub, and help shape the DNA early of Ethiopia capital market. For the region, it is a step towards breaking the historical fragmentation of African financial system. Let's start by looking at Ethiopia Security Exchange and the late entry, but a strategic one. Ethiopia's launch of a security exchange comes decade later than many African peers. Until recently, its financial system remained state-dominated, bank-centric, and largely closed to foreign participation. Capital raising was primarily public sector driven, private equity was underdeveloped, and portfolio investment was almost non-existent. The decision to open a security exchange and crucially to allow foreign regional players to participate reflects a broader recalibration. Recognition that a bank financing alone cannot meet long-term development needs, a need to mobilize domestic savings more efficiently, and also a desire to attract foreign capital without over-reliance on sovereign borrowing. By inviting Kenyan intermediaries, Ethiopia is effectively importing market experience, a shortcut many emerging markets have historically taken to accelerate financial maturity. Why Kenya matters in this equation? Kenya's capital market ecosystem is the most developed in the region, anchored by the Nairobi Security Exchange (NSE), with decades of operational history, a sophisticated regulatory framework under the Capital Markets Authority (CMA), deep existence in collective investment schemes, REITs, derivatives, and cross-border listing, among others, a strong culture of institutional investment, including pension funds and insurance firms. Kenya stockbrokers, banks, and custodians bring the following: proven system for market governance and compliance, operational know-how in clearing, settlement, custody, and investor protection, experience in retail investor education, and a critical gap in frontier markets. For Ethiopia, this is not just participation, it is capacity transfer. Let's look at the promise of cross-border listing and capital mobility. Perhaps the most transformative implication lies in the potential for cross-border and dual listing. What this could unlock: 1. NSE-listed companies accessing Ethiopia capital pools, Ethiopian firms raising capital from Kenya and regional investors, enhanced liquidity through broader investor participation, and as well as increased visibility of East African firms to a global frontier, and emerging market funds. Dual listing has historically played a catalytic role in deepening markets elsewhere, from Southern Africa to South Asia. For East Africa, this could mark the beginning of a genuinely integrated regional capital market rather than a collection of siloed national exchange. What's the strategic implication for Nairobi as a financial hub? This development reinforces Nairobi's ambition to position itself as the financial nerve center of East Africa. Rather than competing exchange fighting for limited liquidity, a more integrated model allows: 1. Nairobi to function as a regional headquarters for financial services, 2. Kenya institutions to scale beyond domestic market constraints, and 3. East Africa to present itself as a single investable block to international capital. In a global environment where capital increasingly seeks scale, depth, and regulatory clarity, fragmentation is a disadvantage. Integration is a necessity. What are the challenges? A young market that comes with growing pains. Yet, optimism must be tempered with realism. Key risks include 1. Limited liquidity in Ethiopia's early years. 2. Low public familiarity with capital market instruments. And 3rd, evolving regulatory and supervisory capacity, as well as microeconomic and currency risk. There's also the challenge of aligning different legal, accounting, and disclosure standards. Frontier markets are built over a long time, not overnight. Each participant must be prepared for long gestation periods, uneven returns, and the need for patient capital. Where Kenya expertise becomes critical. This is how Kenyan institutions can play a defining role, not merely a profit-seeking entrance, but as market shapers. Their contribution could include 1. Supporting the development of robust governance framework, strengthening investor protection and disclosure standards, training market participants and regulators, as well as promoting ethical market conduct and transparency, as well as helping Ethiopia avoid mistakes made elsewhere in early stage markets. If done well, this partnership can shorten Ethiopia's learning curve by years. Let's now look at regional integration and East African vision, where at a policy level, this move aligns squarely with the East African community long-standing goal of financial and economic integration. Although Ethiopia is not a member of EAC, capital markets integration is often the missing link, harder to achieve than trade integration, but far more powerful in its long-term impact. Integrated capital markets can lower the cost of capital, improve resource allocation, increase regional resilience and to external shocks, and also reduce dependence on foreign debt. In an era of global financial volatility, regional self-reliance matters. Let's look at the bigger picture. African capital markets at crossroads. Zooming out, this development speaks to a broader continental narrative. Africa's growth story has been constrained not by lack of opportunity but by underdeveloped financial intermediation. Strong capital markets are not a luxury, they are infrastructure. Ethiopia's opening up and Kenya potential leadership within it offers a blueprint for collaboration over instead of competition, integration over isolation, institutional building over short-term gains. In conclusion, we can say that this is a historic opening, a shared responsibility. Ethiopia's decision to welcome Kenya financial institutions in its security exchange is historic, but history alone does not guarantee success. What follows will matter more than announcement itself. For Kenya, this is a chance to lead by example. For Ethiopia, it is an opportunity to leapfrog traditional development paths. For East Africa, it is a test of whether regional integration can move from aspiration to reality. If managed with visions, discipline, and mutual trust, this movement could mark the beginning of a stronger, more connected and globally relevant East African financial market, one capable of mobilizing capital, creating opportunity, and shaping the region's economic destiny. So thank you for coming this far. If this is your first time here, please consider subscribing to this channel. You can also watch other videos that we have made on different topics. You can leave a comment, share, and like. Thank you.